Good evening, everyone. We're going to do something really unique tonight. We're actually going to start on time. So, yeah, all right. Thank you for the applause. No, welcome. We think this will be a fun night tonight, and obviously you all want to know what now. You know, we talked beforehand. We had a little event in November, didn't we? What if? Well, what if happened, huh? So here we all are. So tonight we're going to spend the next hour and a half on what now, and the format's going to be a little different. We are going to have a lot more time for questions, folks. So be thinking. And I'd like to go through the packet here. First of all, this kind of green, teal, whatever color this is our evaluation sheet. Also, we have giveaways tonight. So we are going to be collecting these prior to being done, and we have 10 gifts we're going to be giving away. You know, you're going to have your choice. 5 of you are going to have your choice of books, and 5 of you are going to be walking out of here with some silver. Yeah. All right, precious metals. So anyway, give this some thought. And you know, this first question, this is something a little different. We've never put on an evaluation form, but we'd like you to think about that. And this is something that we do talk about with our folks, and we want to get people refocused on it. You know, and really just ask yourself, if today was 3 years from today, what would have had to happen for you to feel that you're happy with your progress? I think that's kind of a neat open-ended question. You know, and that's not just financial. You know, that can be life, that could be charitable goals, that could be family goals. So, so if you could take some time with that. But again, the girls are going to be collecting those before we get out of here. Inside your packet, you have one of these, and if you don't have one, please raise your hand. You will notice that none of these slides are titled. That is by design. You know, our goal is to keep you engaged. So Gary's going to go through each of the slides as we go through here. But we think that this is going to be a really neat program. And again, no topic's an unfair topic. There is a ton of data that we're going to be covering tonight. Some of you, maybe your brains are going to explode a little bit. A lot of charts, a lot of economic data, and then we're also going to get into a lot of the what ifs. You know, what we're seeing some people doing, or what our feeling is what not to do, and then also what to do. Okay, so we're actually going to give you some action strategies tonight. So, you know, I don't want to go too long because we want to get to the meat of the program and then get to your questions. But first of all, I'd like to introduce my good friend Gary Rathbun. You know, those of you, I assume most of you are here because you're regular listeners on a show that was started a few years ago. It's changed here of late, and you know, that's what life's about change. So we have a new host we're getting used to, and we think the show's getting better. But if you don't listen to After the Bell, we encourage you to do so. We think it's a pretty good program. And then Eye on Your Money is, for those of you that aren't aware, it started out as 2 nights. It's now 3 nights a week. You know, Tuesdays, Wednesdays, and Thursdays. In addition, many of you may not know this, it's actually Eye on Your Money is on SPD every night from 10 to 11 p.m. for those of you that are a little bit more night owls. So each show is redone, and then we do a best of as well if you missed any prior shows. So we encourage you to listen. So yeah, we're excited about that. And you know, Gary and I, for those of you that don't know, he and I have been together pretty much my whole career, 27 years. So we're both getting older. One of us has a little bit more hair than the other, but we're both very gray. And I've actually been with him as long as I've been with my wife. So he's the other significant other in my life. But you know, with that, I'd like to bring Gary up, and you know, my business partner, my good friend. I'd like you all to welcome Gary Rathbun, please.
A little concerned about that significant other comment. Not that there's anything wrong with that. That's right. I appreciate you all coming out tonight. President's Day. It seems appropriate to talk about these kind of things. For how many of you this is the first time you've ever seen me? Do I look like my voice? See, I used to ask people that come into the office from the radio show, do I look like my voice? And one lady said, no, you sound thinner. So we don't ask as often anymore. But I did have an experience today that let me know I'm becoming a minor celebrity in this town. I got a personal VIP invitation to a colonoscopy. It's VIP colonoscopy day, and I can choose my own staff member to do it. So, pretty excited about that. I'm going to end my presidential hopeful right here. Okay. Want to get started on this and get into the meat. All of you should have an envelope, and in the envelope there should be a yellow page. I want everybody, I'm going to step off the stage yet. I want everybody to take this yellow page and hold it up at me. I don't care if you put it away, get it out. Okay. The subject matter covered at this seminar is for informational purposes only. The information presented is believed to be accurate and reliable, is not meant to be used for your own personal financial situation. The speakers are not engaged in rendering legal or accounting advice, even though I did stay at a Holiday Inn last week. If legal advice or other assistance is required, the services of a competent professional should be sought. Do we all understand that statement? You're on camera, so I want everybody to nod yes. Very good. Private Wealth Consultants is an SEC advisor, which means that I am deemed a fiduciary every time I talk. And for those of you that have come to programs in the past, you will notice that we didn't spend much time talking about specifics. And the little blue sheet you're going to fill out, and Doug was absolutely right, we're going to collect them up. At 8:25 we're going to have a drawing, and we're going to give away some nice stuff. But the biggest complaint I always got in the past was, you didn't cover enough meat. So we talked to our legal, talked to our compliance, and this is what we came up with. So if any of you go out tomorrow and mortgage your house and put it all in gold, I'm not liable. Okay? So we're here for information. I'll be glad to answer your questions at the end. Okay, I want to get through this so everybody gets the information they came for. But understand, I'm not giving you financial advice. Okay, can't do that in a group. What we're going to do tonight is we're going to talk a little bit about where we are, and then I'm going to spend most of the time on what not to do and what you should be doing now specifically. But I want to give you a little background first. I want to look at some of the charts and some of the information that we look at every day. And you notice you all have copies of these charts. But I didn't give you any titles to the charts. So you got to stay here and listen to me. Okay? Kind of like a Cherry Street mission. You got to listen to the sermon before you get the good stuff. This first chart is 12 months of food stamp participation. Over the last 12 months, we have gone to 15% of the population is now on or using some type of food stamps. Over the last 4 years, I'll let you draw your own conclusion as to why I chose 4 years. But 17.3 million people have been added to food stamps and Social Security disability. 17.3 million people have been added to food stamps and Social Security disability in the last 4 years. Right now, there's one person taking food stamps for every 3 people in the workforce. Couple that with one person collecting Social Security for every 3 people in the workforce. Those three people in the workforce need to work. Okay, next chart. This is for every dollar of debt right now, we gain about 8 cents in gross domestic product. In the past, 1947 to 1952, for every dollar of debt, we gained $4 in gross domestic product. 53 to 84, we gained 63 cents. Through 2024, and now we're down to 8 cents. That means every dollar of this quantitative easing we're seeing, every dollar that comes in, we have 8 cents added to the gross domestic product. Not very much. Now, you may say, yeah, what difference does it make? Let's get to the meat of it. I'm going to refer back to this in what to do. So this is our foundation. This is our background. GDP versus the growth of money. Now, for those of you that have listened to the show, you know I argue about inflation quite often. And my definition of inflation back when I went to school during Eisenhower, that's a mild attempt at humor, not as old as I look. But back then, we defined inflation as an increase in the money supply, M2. You notice, well, you may not notice, but Wall Street Journal and other places like Bloomberg, they don't publish M2 anymore. Used to be able to get that all the time. Every month they would publish M2, now they don't. But M2 is growing faster than the gross domestic product. This chart goes back to 2005. 2005 deemed as 100. Gross domestic product is at 127. The money supply is at 160. Now, we haven't had inflation yet, and we'll see why in a few minutes. Trading volume on our stock exchange. Trading volume is going down every day. We have very little trading volume in our markets today, and yet we still have quite a bit of volatility. I think this is mainly because of the rise in exchange-traded funds. Everybody familiar with exchange-traded funds versus mutual funds? The volume of these is going up exponentially, and the volume of mutual funds is going down exponentially, and we'll see that in a few minutes. Median income for the United States is back to where it was in the mid-'80s. So we are not growing our income as a nation. This one's a semi-interesting chart, once you know what it is. Federal Reserve share of the Treasury market. Right now, our Federal Reserve owns better than 14% of all outstanding debt issued by the Treasury. This is going up to the tune of about $86 billion a month. By November, just a few weeks ago, the Fed balance sheet passed $3 trillion. By November, we'll be over $4 trillion. And we're adding $1 trillion about every 11 months. So by the time President Obama is out of office, Federal Reserve balance sheet will be between $7 and $8 trillion. We'll see the significance of that as we go. Price of gold in relation to the Federal Reserve's balance sheet. What we've done here is project out the little brownish yellow line is the Fed continuing to buy at $40 billion a month. And the reddish purplish line is the Fed continuing to buy at $86 billion a month, which it is currently doing. So you can see the relation to gold in the Fed balance sheet. Once again, I'm going to come back to this, so this is important. Now, you remember I said we're not having much inflation yet, even though we've increased the M2 by over 60% in the last few years. We've increased the money supply. The Fed has digitally printed money. It's a good thing we're in a digital age, because if we printed money like we used to, or we physically printed money, they could not print money fast enough. They could run their printing presses 7 days a week, 24 hours a day, 365 days a year, and come nowhere near the amount of cash we need to print. So with a push of a button, the Bernac can create money. He gives it to the Treasury, and then he borrows it back, or buys the debt back. What this does, it shows you on the chart on your left the velocity of money. And you've heard me talk about this on the show. The velocity of money right now is around 1.57. Now what that means is every dollar that goes into the economy over a year's time has an effect of $1.57. So if I buy something, if I spend $1, over the next 12 months, that dollar adds $1.57 to the economy in velocity. So extrapolate a little bit. We've increased the money supply by 60%, over $3 trillion in the last 4 years. What if the velocity was normal at 2 or 3? Once again, back in Eisenhower days, when I was in school, the velocity of money was between 5 and 7. Remember when President Bush sent us all a $600 check? Remember that? Okay. Or most of us a $600 check? And of course the Democrats and the media were poo-pooing that. Well, it's $600. What effect is $600 going to have? Well, the year he did that, the velocity of money was 7. That was like giving each of us $4,200 in the economy. That's why it had an effect. Now, I don't agree with giving everybody a $600 check. Don't get me wrong, I'm not supporting that. I'm just saying the economic process was a much higher velocity, a much higher multiple. I won't even get into what Dodd-Frank is going to do to our economy. I'm starting to write a series of articles for the Free Press. First one will be published Sunday, I believe. A series of 3 or 4 articles on Dodd-Frank legislation. You think Obamacare is bad? You should see the Dodd-Frank legislation. This stuff's incredible. Housing starts. This is the one of the few slides that I'll show you that is fairly positive. We're up 20% increase in housing starts, even though they're still very low. But the data we're getting shows that we may be bottoming out on housing starts and new construction. Now, this one's very interesting. U.S. Treasury versus the VIX. The VIX is a measurement of volatility in the market. It's a volatility index, hence the VIX. Now this chart is a little confusing in the sense that the VIX line is inverted to the U.S. Treasury yield. So if you look back in January of 2009, you see the VIX line and the Treasury yield line are moving together, which means they're actually moving exactly opposite. Okay, you with me on that? As we've come into 2012 and now into 13, now they're totally non-correlated in this chart, which means they're moving together. So the volatility index and U.S. Treasury yields are moving together. Okay, totally opposite of what it should be. And the reason for this is that our volatility is tied more toward Europe than it is our own economy. Once again, very important thing to remember as we get into what to do now. So you can start to see where I draw my conclusions. Once again, our financial conditions versus the European risk. Our risk and the euro are moving in lockstep. This is the Goldman Sachs financial conditions chart versus the euro risk. And once again, it's an inverted chart. So as the euro gets worse, we get exponentially worse. So we will be affected seriously by the euro. Very sluggish economic expansion in the United States. If you look at the job market and see where the jobs are being created, because there's so many people unemployed, there's a real downward pressure on wages. And those of you that have been in the marketplace understand this. And what we have is a basic supply and demand where we have more people vying for jobs, so some of us as employers, we don't have to be so competitive in our wages and benefits. This is part of the sign of deflation. Once inflation starts to kick in, then we will have more upward pressure on those wages. Most of the job growth is in retail trade and leisure and hospitality. So not big pay sectors, not big growth sectors. Central bank balance sheet expansion. The little purple line or blue, whatever it is on the bottom, is our Federal Reserve. So as much as I complain and gripe and illustrate how bad the Federal Reserve balance sheet is, you can see compared to the European Central Bank and our beloved People's Bank of China, we're not in bad shape compared to them. It's like being the last guy drug off the edge of the cliff. You're not going to be the first one to hit bottom. Okay? But they're all expanding tremendously. And like I said before, our balance sheet is going to expand a lot between now and November and a lot between now and the end of Obama's second term. This is the same chart except in numbers. The expansion of the central bank balance sheet has grown over $9 trillion in the last few years to over $16 trillion in central bank assets. Federal Reserve balance sheet, as you've seen the interest rates drop over the last several years, Bernanke has brought the interest rates down tremendously. The assets of the Federal Reserve have gone up exponentially. Now, with interest rates so low, how many believe interest rates are going to go up? How many know when? None of us. Okay? We don't know when interest rates are going to go up, but I suspect it's going to be a long time before interest rates go up. And the reason being is 1% increase, a 1% increase in interest rates will cost the federal government $170 billion per year more. 17 trillion of debt. We will reach 20 trillion of debt before Obama leaves office. Reason we haven't seen inflation is none of that money has made it out into the economy. How many of you tried borrowing money for your business from a bank lately? It's a lot tougher than it used to be. Okay. Banks just are not lending out money. And I did an article a while back that illustrated the increase in the M2, the increase in money supply versus the increase in major bank assets versus the amount of loans they put out. Just because I have that kind of time. Okay. But it's interesting, the amount of money being created and the amount of money being put into banks on their reserve side is almost identical. And the amount of money these banks are putting into the market versus loaning out to people is the same number. They're just not loaning money out. and that's why we don't have the inflation that we should have with this type of monetary expansion. Now, we've never had this kind of expansion before. We've never had this kind of monetary policy. I have no idea what it's going to do. I have no idea how bad this is going to get before it pops. And it will pop. The Fed can't go on forever. He thinks he can, but he cannot. There's two measures to the federal deficit. One is a cash basis, one is an accrual basis. And you can see there's generally 2.4% difference on average between the cash and the accrual. The accrual is much more accurate. So the debt they're telling us is a little bit different than what is actually out there. Government is really good at manipulating these numbers and masking the total indebtedness. Looking at the federal funds rate, I won't get into this too deeply because it's pretty technical and somewhat boring. But the Taylor rule, if we use the Taylor rule to estimate interest rates versus the Evans rule, right now they're using the Evans rule. The Evans rule says that interest rates based on Federal Reserve assets today, interest rates should be a negative 4.8%. In other words, somebody should be paying me 4.8% to borrow money from them. I'll get in that line all day long. Okay, I'll mortgage my liver to get 4.8% return on it. The Taylor rule is a little bit different. It measures the interest rate based on the assets in relation to unemployment. And that says under current assets, the unemployment should be around 6.5%. And we know it's at 7.9, which is really 14.6. Okay, average hourly earnings and labor market slack, you can see that the average hourly pay is going down. And what the Federal Reserve feels is this is simply cyclical and that quantitative easing can fix this. Well, as we've seen, quantitative easing does not fix this, so quantitative easing is here forever. Let's switch gears a little bit. Not that this is any more fun than the unemployment numbers. But this is a 12-month price-earnings ratio of the entire S&P. And you can see the S&P 500 right now has a PE ratio of about 15. PE ratio is simply the market price of a stock per share divided by the earnings of that company per share. So a lower PE tells us that a stock is a better buy generally than a higher PE. I had a client come to me years ago. What was the stock? It was, I think it was eBay or Yahoo or one of those. I forget what it was. And he wanted to buy it. And he said, Gary, what do you think? And I said, at 300 times earnings, I think that's the stupidest thing you could buy. And he said, well, buy it for me anyway. Which is my job, you know. If you want to be dumb, I'll let you be dumb. Well, the stock doubled in price over the next 45 days or so. And he couldn't help but come into my office and he goes, what do you think now? And I said, at 600 times earnings, it's even dumber than it was before. So I got him to sell half of his position and now he's playing on house money on that. So, but earnings related to price is very important. And as a broad market indicator, this will tell us whether a market is oversold or overbought as one factor. Just wanted to throw this in here because it's going to come up again in a few minutes. But this is the market vector for coal. And when President Obama was running the first time, he said, I got no problem with coal. If you want to produce electricity using coal, I think that's great, but we're going to bankrupt you to do it. And he has held true to that promise and has driven down the price of coal tremendously. It's down about 58% from where it was. Now, you'll see the chart, and it's starting to bottom out at the bottom of the chart. We're going to talk about this in a few minutes when we talk about commodities. But this is kind of stuff we look at, and coal is not going away. Hopefully in 4 years, President Obama is going away, and this may be something to look at. So. And I don't want this meeting to be political, understand that, but once again, you're here because you've heard me on the radio, and I'm not real shy when I'm in a small room with a microphone all by myself. So, next one. This is fairly interesting. There's a dispersion of returns in the currency market. And right now, the G20 is going on. You've seen the news where the G20 is in session, and a week or so ago, the G7 was in session. And these are the 20 biggest economies in the world, and they're talking about currency wars. And Japan in the last few weeks has been really pushing their currency value down. And this is good for a country. It's bad for a people of a country, but it's good for the country. When they reduce the value of their currency, they make their exports cheaper. So they export more. And what we have is major currencies, the United States dollar, the euro, the yen, Chinese yuan you can count, but they manipulate their currency so bad it's not even funny anymore. But the major currencies are in the world are in a race to the bottom. They all want to devalue their currencies. And in our investment meeting this morning, we talked about, do we want to buy currencies? And we scratched them off the list for today because the G20, the officials came out and said, no, 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 you know what, we support Japan, that's cool. None of us are going to get into a spitting match of lowering the value of our currencies. And what that told me was they're all going to run home and start lowering the value of their currencies. So I wanted to wait a little bit on that. S&P price to book ratio. This is similar to the PE ratio, but it's price to book value. Book value is if you liquidated the company, closed her down, sold the assets, cashed in everything. What's the book value? On average, the S&P is trading at 2.1 times book value right now. Not bad. Not a bad ratio. And you can see in recent history, we've been at 5 times book value, which is a big number. Corporate profits as a percentage of GDP. Corporate profits are at an all-time high. And it's mainly because they've been able to cut costs, cut labor, and make their products a little cheaper on the market, plus the cost of their funds are a little cheaper. A couple more slides, then we get into the interesting stuff. Dividend income versus interest income. First chart, you'd see where interest is gone, and if any of you have investments like CDs or bonds or anything like that that generates income for you in your retirement or pre-retirement or whatever, you know interest rates have come down dramatically the last several years. What's interesting is the dividend income has gone up dramatically the last several years. This to me is interesting because it shows that companies that have at least 30% of their income generated outside the United States, in other words, they're a global company or have international sales, on average, they have much higher margins, they have a higher return on equity, and of course, they have lower taxes. we're one of the two worst countries in the world on taxing corporations. Japan. It's one area where I don't mind Japan beating us. Okay, this chart shows how consumer staples are outperforming the S&P 500. So this is from a home builder standpoint, Home Depot, Toll Brothers, that kind of stuff. Media, Comcast, Disney, and retailers, Amazon, Starbucks. By the way, Amazon is one of those companies with a 600 PE. So just to put that into perspective, price-earnings ratio, if a company has a PE of 12, that means it takes 12 years of earnings to give you the stock price. Amazon has a PE of over 600. It takes 600 years of current earnings at Amazon to get you back your stock price. That's a hell of a wait. I don't know about you, but 12.2 is questionable for me nowadays. S&P stocks with dividends greater than treasuries. Currently, there's over 57% of the S&P 500 stocks that have a higher dividend than current treasuries. Now, part of that is treasuries really stink right now, but also a big part of it is companies are shifting to paying out dividends and higher dividends. Stockholders are demanding it, not only from getting more money, but also from a tax advantage. Dividends are better to receive than interest income from a tax standpoint. So companies are under pressure to use the cash that has been building up. And they have been building up a lot of cash. Last decade, your booming demand from emerging markets has been a major driver. And Asia leads that demand. Just from a gold standpoint, in 1999, Asia accounted for 39% of the gold demand in the world. Today, this same region accounts for 57% of the world's demand of gold. And you can see what's happening in China. China retail sales versus their industrial production is climbing dramatically. They are still a major market for us and will continue to be for a while. Remember I said how ETFs are taking off? This is what's happening to mutual funds over the last several years. Assets are declining dramatically out of mutual funds. What is going into mutual funds is going into high yield. People are searching for yield, and we're going to talk about that in just a couple minutes. But it's human nature that when one income producing asset goes down in yield, you seek out other assets that are higher in yield. What's happening is investors are taking on a lot more risk than they think they're taking on. Corporations are taking their cash, leaving it in their own stock and investments. They're borrowing money to pay dividends because they can borrow money cheaper than they can use their own money to pay dividends. Well, that creates a lot more risk than what people think they're taking on. This is something that's fairly exciting. This is the oil production in North Dakota. By 2020, the United States will be a net exporter of energy, coal and natural gas. Chris in the back, the tall guy in the suit, is our internal analyst. He was telling me today how California is going to be a major producer of energy due to fracking. And of course, Chris, in his usual quiet way, says, of course, there's a little issue with the fault lines, but I think they'll figure that out. You know what? I think if we could trade California for a bunch of natural gas, I'd vote for that. You know. This is the price of gold in the introduction of the gold ETF. The gold ETF came out in 2004. So prior to that, you see at the bottom the yellow line. That's what gold has done. It's the left side axis. In 2004, we had the gold ETF. It has tracked gold almost identically. The dark wavy line going down negatively is the rate of return on treasuries. So as treasuries have gone down, gold has gone up. Now gold has traditionally been a hedge against inflation, but today we have very little inflation. What it is now is a store of value from people being afraid. Just as a sideline to the gold, these are the major mining companies. And we will look at those in a few minutes and where they fit into the portfolio. Like I said before, gold has been seen as an inflation hedge, and this bottom dark green line is how gold has performed spot price to the CPI under Bernanke. Not very well. Stocks have underperformed with Bernanke, and the Fed has a real credibility problem today. Nobody believes what they're putting out. This is where gold has been seen as an inflation hedge, like I said a minute ago, and how it is separated from the CPI. We have very low declared consumer price index, very low declared inflation. And that's because the money being printed is not being put into circulation. Remember, we talked about the velocity of that money. So we printed a few $1 trillion, but we haven't done anything with it. It's literally sitting in a pile in several banks. The banks that are too big to fail. Okay? So this, to me, illustrates fear. Okay, that's our background. Now, start off with a few things not to do. First thing I don't want you to do is buy annuities or life insurance as an investment. Virtually everybody that comes into our office from the radio show has some annuities in some form or life insurance in some form, and it was sold as an investment. We have people that will swear on a Bible that that annuity guarantees them 7% return. And it does not. It guarantees you 7% payout. And that's a little different. So we have seen so many abuses on this. Doug could come up here. I let Doug handle most of that aspect. And he could tell you stuff that's just darn near criminal with abuse of annuities. So the first thing not to do with what we have learned tonight is buy annuities. Remember a few years ago, $1 trillion was printed by the Federal Reserve and given to support insurance companies. Anybody know which one's got the $1 trillion? Nope. Nobody knows. Because they won't tell us. For fear that we'll pull our money out of that company for lack of trust. It wasn't AIG. Okay, that was a different situation. High-cost mutual funds. A few of you before the program came up and talked to me, and we was talking about mutual funds. I got a real problem with mutual funds. Once again, those of you that have listened to me for any amount of time know I am not a mutual fund fan. Mutual funds come out and they publish their M&E charges, management and expenses, what we lovingly call meals and entertainment. Okay? But what they don't tell you is what the SAI tells us. And the SAI is supplemental additional information. On average, the M&E number that you see published is about 50% of the actual expenses of the mutual fund. So if they come out and say, hey, our M&E is only 1%, The supplemental statement of additional information will tell you that's about 2%. What's not included in that M&E is transaction costs, marketing materials, bonuses, that kind of stuff. Non-publicly traded REITs. I can't tell you how many people have come into our office with a REIT that's supposed to pay them good income. It's non-publicly traded, which means it has no liquidity feature, and suddenly their dividend went down to 1% or 2%. Treasuries. When interest rates go up, and we all agree interest rates are going to go up someday, right? Say yes. Thank you. That means the value of those treasuries are going to tank. Now, they will tank until they mature, but they will tank nonetheless. Because of that, we don't like long-term bonds in any form, corporate or treasury. We keep all of our bonds very, very short term, within 3 years. Because of that, we don't use any bond funds or even bond ETFs. If you look at a bond fund or a bond ETF, they will come out and say our average maturity is 7.6 years or 8.5 years or something. So it's 7.6 years. A year from now, it will still be 7.6 years because it's a basket of bonds. And they keep buying more and renewing them. If you buy an individual bond, it's a 3-year bond. A year from now, it's a 2-year bond. And 2 years from now, it's a 1-year bond. Farmland. Now this comes with a caveat. Don't buy farmland unless you're a farmer. Okay? I can't tell you how many people have called me up, come into the office, called the radio show, hey, what about farmland? Okay? My answer is always the same. Are you a farmer? No. Then don't buy farmland. Okay? Farmland is high right now. My nephew in the back will tell you that. He's a farmer. He's allowed to buy farmland and not be cut out of my will. Okay. But it's high because the commodities are high. So it's designed, or it's priced as a multiple of the underlying commodity. Well, unless you're a farmer and get some economies of scale, you're not going to cash flow $10,000 an acre farmland. Okay? And I remember the argument. My dad told me, oh, they're not making it anymore. Yeah? Well, there's a reason they're not making it anymore. Okay? It's just very, very difficult to cash flow. Along that same line, real estate flips. You're hearing a lot of advertising about we can show you how to make a ton of money in the Toledo market flipping real estate. Okay, well, how you make a ton of money in the Toledo market flipping real estate is charging people to teach them how to flip real estate. You don't make a lot of money flipping real estate. Now, if that's your business, like farming, God bless you. You're in good shape. Flip the real estate. There's good buys out there. If you got the money, you got the crew to do it, you got the skill to do it, blah, blah, blah. God bless you. But for the rest of us, don't do it. And finally, get out of debt, especially consumer debt. Anything that's consumer debt or variable rate debt, get the hell out of. I have people in my business that are nationally known that will tell you, borrow all the money you can borrow at fixed rate. Borrow it all. Because when inflation hits, you'll be able to pay that off with cheaper dollars. Well, the variable in the equation they don't tell you is where you're going to get the cheaper dollars. I'm an employer. If inflation comes out at 10% next year, I'm not giving all my employees a 10% raise. Sorry, Katie. Okay? So there's a time lag between inflation and income. Okay, what do we do? First thing we do is remind everybody we got the yellow sheet, right? Everybody nod, you're on camera. Okay. I don't want you selling your house and doing anything I'm saying up here. First thing we do is look at blue chip stocks. We want blue chip stocks with a high dividend. Now, I can remember being in business back in the mid-'80s, and we used to have a saying that the blue chips of today are the buffalo chips of tomorrow. Well, I'll worry about that tomorrow. Today, we need blue chip companies. These are companies that pay high dividends, good PEs, low debt to equity ratios, and remember the chart? At least 30% in international revenue. So we're looking at Johnson & Johnson, Procter & Gamble, ConocoPhillips, Exxon, Merck, Lilly, Bristol-Myers, Disney. What else, Chris? Something. Walmart, Waste Management. Okay? You can do a search for these companies where you go on, punch in the debt ratio, punch in the dividend, punch in the equity, punch in the international sales, and it will kick out the names of those companies. So that's the first thing we're looking at. Now, recession comes, even a deep recession comes. How many of you are going to quit buying deodorant and toothpaste? I want to know. Because we won't have a meeting in my office. Okay? So these are companies you're still going to buy the product. They're going to survive a recession. Doesn't mean they won't get beat up a little bit, but they're going to be around. Carnival Cruise is not a blue chip stock right now. That's more the buffalo chip thing, you know. Commodities. We want to look at agricultural commodities. Last year, that was a home run. Okay, partly because of the drought, mainly because of the drought. Energy commodities. What are the two things we all need no matter what? Food and energy. The third thing is drugs, but that's a different subject. Okay. Basic materials. Once the economy does bottom and start recovering, manufacturing will lead the way and housing will lead the way. So we will want to invest in basic materials. We had an old joke back in college in the economic days that copper was the only commodity that had a PhD in economics. Copper is a 6-month leading indicator. So once you see copper starting to come off the bottom and go up in price, that's starting to tell us things are recovering. Now we have to look at that very carefully because China, God bless them, has stored up about 2 years worth of copper in a warehouse. So that may skew the numbers a little bit. Currencies. We want to go both long and short in currencies. Long means we buy it, short means we sell it. Going long, we want to look at Canada, Australia, maybe Brazil. Okay, what's Canada and Australia have in common? Natural resources. These are commodity-based economies. Okay? Short, I want to be short the euro. I want to be short the yen. I don't think anything's good is going to come out of Europe probably for the rest of my life. About the only thing that's good that's going to come out of Europe is Germany's going to leave the European Union as soon as they can arrange it. Why do you think Germany just requested the repatriation of a lot of their gold? They're lining up the cards. we do a lot of CDs in foreign currencies. For those of you that like CDs and like that FDIC insurance, even though that insurance is leveraged at 1,000 to 1, not that there's anything wrong with that, okay? But FDIC insurance on CDs in foreign currencies. So we can buy a CD in America. It's insured in America by the FDIC, but it's in a Canadian denomination or an Australian denomination or any other currency we want. Precious metals is kind of an obvious one, I understand that. But I think we recommend, and I think that everybody should have 5+% of their investable assets in metals. Gold, silver, and the sleeper, platinum. Nobody talks about platinum. Now, by hard assets in your possession, that means in the sock drawer or under the bed or somewhere else. Okay? And we can do a whole nother segment on where to buy that gold and silver. But we're not going to do that tonight. If you want to know, you can call the office and we'll give you recommendations as to where we buy ours. Okay? And it's not from a jewelry store in any state. We also invest in precious metals and ETFs. Now, people can come out and they'll argue against that, saying, well, you got counterparty risk. It's absolutely true. And you don't know if the gold is there or not. That's absolutely true also. I was just in Florida. Doug and I went down there to the largest ETF conference in the world. And they have an area where all the ETF guys are there and you can talk to them. And I went up to one that we use on gold, silver, platinum. And I see he's starting to tell me his spiel. And I said, forget the spiel. I already use your ETF. Prove to me the metal actually exists. Prove it to me right now. And he said, well, first of all, you have our reputation. And I said, you haven't proved anything to me. You've just made a stupid statement. And he said, well, okay, but our ETF goes through JP Morgan and you have their reputation. And I said, that's dumber than the first statement. I said, neither one of those things prove to me you have any gold or silver. Now, I already knew the answer. I was just giving him a tough time. See if he knew the answer. Answer was, he showed me a third-party, independent survey of the metal they have in their London vault. I knew the company that did the survey. They have it done every 6 months. He showed me legal documentation that prevents the London metals vault from rehypothecating their gold or silver. You familiar with rehypothecation? That means that, well, let me step back. I love the Socratic method of doing things. Germany asked for their gold back, right? Remember that? From London, New York, and Paris. Give us back part of our gold. What did New York say? 7 years. No problem. It's in our vault. It'll take us 7 years to get it out and ship it to you. What are they doing? Strapping it to dolphins and shipping it over? 7 years. The reason being is the New York Fed has rehypothecated that gold, meaning they have leased it out to someone else for a fee. And it will take a while for those leases to run out and for them to get their gold back. Now, once again, I can spend a whole evening talking about rehypothecation. I've done a lot of work on that. Companies we use don't allow their metals to be rehypothecated. Not only did they give me 6-month surveys on the gold actually being there and certified being there, they also randomly test the bars every 6 months to make sure we're not buying or investing in gold-plated tungsten. Okay? So I felt a little comfortable with that. Mining stocks, we talked about those before. We do invest in mining stocks. That's a less efficient way of investing in gold. or silver or platinum, but it does give us some diversification into the effects of that metal in the economy. And of course, currencies. I keep bringing this up, just like buying CDs in foreign currencies, we buy metals in foreign currencies. What this does, it gives us what we call an arbitrage between the dollar and the currency we're using in investing in the metal. So it gives us a little bit better return, even though it's very, very safe to do it this way. Private equity and private debt. The Fair, what's it called, Doug? The Fair Jobs Act? Fair Jobs Act went into place January 1. Now, every piece of legislation in the universe has what we call unintended consequences, correct? Sometimes those unintended consequences are good, if you know how to take advantage of them. What the Fair Jobs Act did is created a situation where it was very favorable to invest in private equity and private debt. So we use these two items in our investment portfolios. And what this is non-publicly traded investments in private companies. And we've done extraordinary due diligence on this. So we can get higher returns. And the individual investor, what the legislation did is took away the restrictions for the individual investor to invest in these assets. Prior to January 1, 2013, you needed to have $1 million of investable assets before I could talk to you about these types of investments. Since January 1, you don't. So it opened up a whole new investment category that we could not use for many of our clients that we can now. Okay, you need to start shifting income. The new tax laws went into effect. We need to shift as much as we can to capital gains. You're starting to see through some of these charts what the companies are doing as far as interest and dividends and capital gains. And we advise our people to shift as much income to the lower brackets as possible. This may surprise some of you that have listened to me on the radio. We may need to max out retirement plans. Now, we've talked on the radio several times. People have called in and says, what about the government nationalizing my 401k or nationalizing my pension? One, yes, that's going to happen. Two, it's not going to happen for a long, long time. Three, we're going to see it coming. Okay? There is over 22 trillion in retirement plans. $22 trillion. That's too big of a cookie jar for these people to keep their hands out of. We know that. But they know they can't stick their hand in and grab a handful of cookies. They can stick their fingers in and ask for some crumbs. And what you're going to see is retirement plans be required to have 5% of their investments in treasuries, just to be safe. Well, 5% is good, 10%'s got to be better. So next year, we'll make that 10. And if 10 is better, then, hell, 25's got to be great. And eventually, they'll get to 100%. Once they get to 100%, then they've nationalized it. But we will see that coming beforehand. They will not come out and say, 100% has to be in treasuries tomorrow. Can't happen. Cannot happen. So in the meantime, we max out everything we can from retirement plans. 401ks, pension plans, deferred comp, IRAs, Roth IRAs, anything we can get a tax break on, we max out on if we can. Need to insulate assets. March 27th, 2013. It's in the future. In case you don't know what day it is, I sometimes lose track. March 27, 2013, Ohio, of all places, came out with, or is coming out with, a brand new asset protection law. Phenomenal. Phenomenal law. I know that just about makes my tongue fall out to say that. But on March 19th, 2013, right here in this very room, we will have some attorneys who is in the back. Mike, raise your hand. Mike Henry is going to be where I'm at, and he's going to share this law with you and how it can protect your assets and protect them from many, many things trying to attack them. So March 19th, now on your blue sheet, there's a place for you to sign up for the March 19th seminar. So if you would like to attend that, put your name and address on there and you'll have your reservation done already. But this law applies to everybody regardless of your net worth. If you own anything that you want to protect, you will want to learn about this law. Lawsuits, ex-wives. No, you're too late for that one. I'm still good. And I'll let Mike answer that at the March 19th program, but it will help protect it from many, many things. Lawsuits, taxes, frivolous lawsuits, insurance claims, like I said, divorces, that kind of stuff. It's a good piece of legislation. Prior to this piece of legislation, we used other state laws like Delaware, Nevada, North Dakota, and Alaska to set up trusts. But anytime you go out of state like that, it costs a lot of money. Well, now we can do it in state, and we can do it a lot cheaper. Personal security. Internet privacy. I'm going to do a couple radio shows on this, but with everything the government is trying to do, and you remember I mentioned Dodd-Frank legislation. Part of Dodd-Frank legislation is a new bureaucracy for data collection. Now, what kind of data do you think they're going to collect? Google already has a policy in place where they keep track of everything every site you've gone to, and they've already shown they will report that information to the federal government. Not going to get into a Second Amendment discussion tonight. If you're here because you heard me on the radio, then we're all on the same page. Okay? They are not going to ban guns. They're going to try, but they're not going to. And I don't know if anybody see the legislation that was accidental legislation out of Portland, Oregon, or Eugene, Oregon, or somewhere out there on the West Coast that required, if you have an assault weapon, it required the police to inspect your home once a year without a warrant. Required them. Now that was a mistake. We didn't really mean to put that in there. No. And oh, by the way, the legislation isn't going to pass anyway. So, I mean, it's just so lame, these legislators. But guns and ammo. How are you going to protect what you have if the guy trying to take it's got a bigger gun than you? You know, I've been in discussion with many people saying, I don't need an assault rifle. You're right, I don't, unless you got one. Rules of engagement are set by the enemy. I mean, you try to steal my stuff with an assault rifle, and I'm defending it with a 12-gauge pump, I'm going to lose. Okay? Government wants to ban assault weapons. What do you think they're doing with our tax dollars? Buying assault weapons and ammo by the millions of rounds. Part of defending yourself and surviving is being fit. Now, I know that sounds contradictory coming from me standing in front of you, but I'm working on it. I am smaller than I was a couple weeks ago. By the way, you want to lose a lot of weight real quick? get the flu. That's a real jump starter on your diet. Finally, self-reliance. Do everything you can to be self-reliant. Okay? I live on 65 acres. I got bees. I'm hoping honey is declared a currency sometime. I'll be in good shape. But every weapon I have dyes and everything I need to make my own ammunition. So let them try and confiscate all of that. Okay. And finally, keep listening. I just got my first ratings book for Eye on Your Money, and you guys have made me look really good to Clear Channel. And I really appreciate it. I really do. It's a lot of work doing that show, but I have a lot of fun. I get a lot of help from the office and from my partner Doug, but if nobody's listening, Clear Channel doesn't really care about me. So my ratings are knocking their socks off for the 6 to 7 o'clock hour, which is the worst hour of the day. And like Doug said, they've started rebroadcasting from 10 to 11. So in case you missed me, I am on 13 shows every week on WSBD. So I appreciate it. And now, okay, the blue sheets, I want everybody to fill them out, fold them in half, pass them to the center aisle, because we're going to put them in a box and have a drawing. So everybody fill those out, fold them in half, ship them to the center, and Katie will pick them and put them in a box, and we're gonna pull the prizes. We've got 5 1-ounce silver eagles we're going to give away, and 5 copies of Atlas Shrugged with a copy of Ron Paul's book on gold. So you get 2 books. Okay?
While we do that, how about we get started with some questions?
Let's open it up for questions.
What to do, what to do, you mentioned commodities.
Yes.
Energy.
Yes.
What do you think about solar?
Not much. The trouble I have with solar is that it relies too much on subsidies by the government. I think it's a viable energy source, but I have trouble investing in a company whose business plan requires government grants and money. Okay, I'm a firm believer in the free market, and I think we can produce efficient, marketable solar panels, but we got to get away from the government subsidies before I'll invest in them.
How do you purchase CDs in foreign currencies?
There are banks that we work with that have set up divisions that will put their CD and price it in the exchange rate at the day we buy it. So it's essentially, without getting too complex, what they're doing is allowing us to buy a CD with a call option against the currency that we choose. Okay, so Canada right now is paying 1.25% for 12 months. Doesn't knock your socks off. But you add the 1.25% to the potential of exchange rate variance, and we can make more money on that. So there are banks that we work with that allow us to do a CD with that foreign currency option against it.
Your take on energy taxes?
From what standpoint?
Coal,
Like road
oil,
tax?
gasoline, you name it.
I think they're going to continue to go up. I know that sounds kind of silly, but it's going to have to level off from the, especially from the road tax on fuel and gasoline. I just don't see them being able to raise it and raise any revenue. Kind of like the cigarette tax. Okay, if there's 300 of us here tonight, if we all buy 1 pack of cigarettes a day, we pay X number of dollars in taxes. You double that tax, some of us are going to quit. And it's the same way with gasoline taxes. Now, what bothers me with fuel taxes is natural gas. They're trying, the EPA is trying to prohibit fracking and the extraction of natural gas. And I think that's a problem. The gasoline tax, I don't think that's a big issue. The offshore drilling leases, I think that's a big issue. Jason?
Well, on the radio one day, I heard you talk about your home being a consumable asset.
Yes.
And so I was wondering what you really meant by that. And also, if your home is your largest asset, how should you look at it if you're thinking about maybe moving? Should you just buy the, put the biggest down payment you can put down so you don't have a big debt?
The two parts to that question. The first is we got into trouble in the economy by thinking your home was an investment. Okay, and we got into trouble because the value of homes kept going up due to interest rates going down, and we consumed the spread. So people would borrow on their home equity to buy a television. They'd borrow on their home equity to buy a car, that kind of stuff. So that's what got us into trouble, is thinking that home as an investment, like it's throwing off income because it's increasing in value through an appraisal. A home is a consumable. You live in it. Okay, and this was, the show you're talking about is when I talked to John Allison, CEO of BB&T, or retired CEO of BB&T, now the president of the Cato Institute. And he said the same thing. A house is a consumable. Doug and I started our careers 30 years ago, and our mentor at the time said, a house is not an investment. Okay, a car is not an investment. You need a car to get to work. You need a house to live in. Okay, so you're consuming that house. Doesn't mean it doesn't appreciate in value. It doesn't mean that you shouldn't buy one. It means that your attitude needs to be that you're consuming that it's not an investment. Okay, it's not like a rental property and you're renting it to yourself. Okay. Secondly, to buy a house, yes, I would put as much down as possible, not because of taxes, not because of size of payment, but it's closer to being out of debt. I'm a firm believer in being out of debt. Like I said, I got 65 acres and I want to be self-reliant. I don't want some $50,000 a year banker walking on my property telling me what to do because he holds the mortgage. Okay, so nobody tells me what to do on my property. Okay, Chris? Yeah.
What is the smallest amount of money that your office would look at to work with somebody? Do you have a minimum?
Generally speaking, no. We don't have a minimum. What we do is we evaluate whether we can provide value for a client based on their objectives for the amount of money they have. So if you come to me and say, I've got $25,000 and I want to retire in 2 years, go for it. And not much we can do. If you say to me, hey, I got $25,000 and I'd like to buy some gold and invest and just see what I can do with it, okay, we can work with you. So we really don't have a minimum, and I used to. I'll be honest with you. Before I did the radio show, I had $1 million minimum. And it was a hard minimum, man. If you came in with 920, you know what? Call me in a couple weeks when it gets up to $1 million. But I started running into conscience problems by turning people away and seeing what my competition, so-called competition, did to them. And I didn't like that. So we got rid of the minimum and we added a bunch of people to help me take care of it. But really, we don't have a minimum. You can come talk to us. We want to be able to create value.
You spoke about all the money that's been pumped into the economy, but we haven't seen hardly any inflation at all.
Right.
What do you foresee when inflation will begin to see it?
When?
Yes.
Oh man, I don't know when.
Or I guess what has to happen then?
What has to happen is the economy needs to get worse, if you will. I know that sounds bad, but unemployment needs to spike, which it will. We're already seeing a lot of inflation, not in prices of food, but in the packaging of the food. So a thing of coffee used to cost us $9.95 and it was 39 ounces. Now it's 32 and it's $9.95. So the price stayed the same, but the packaging went down, which is just another way of inflation. But we will see that. So food and energy, which they carve out of the inflation numbers, once you see that continuing to go up, the rest of the market will. The leading indicator will be interest rates. Interest rates. If interest rates start spiking on you, run.
And I was going to ask, what 2 or 3 indicators would you need to see to think that the recovery is real?
To see what's real?
What 2 or 3 indicators would you look at or have to see that you feel that things have turned the corner?
Libertarian get elected president, maybe? Seriously, economically, I would have to see manufacturing jobs coming back to the United States in quantity. I would have to see innovation being produced in this country. We are a service economy. Well, that only goes so far. We need to get back to creating things. And once again, those of you that heard me know on the radio, no, I'm not a big union guy. Okay, I think unions have done a lot of damage. But I will say this, nobody can produce like Americans can produce. Nobody. And we need to bring those jobs back here, not because of wages or anything like that, but because of quality. Okay, how many of you have bought an appliance that wasn't made in China? Okay, we bought a refrigerator, I forget how long ago, $100 ice maker goes out. Can't get them anymore, got to buy a new refrigerator. Everything out of China is a one-off. Everything is a one-off. Well, that's not us. So as far as an indicator, I got to see manufacturing jobs come back and taxes go down. I got to see, I don't know, Washington get truly free market or float out past the international date line there or international waters.
How about one more question, then we'll do our drawing.
Okay, one more.
Okay, thanks. This is in reference to the asset protection law. Wondering if Michigan residents can also attend this, the meeting, if it's...
Absolutely. Absolutely. We got some more sheets up here, Doug, so...
Oh, okay.
Everybody turn in a sheet.
Anyone else? Going once, going twice. Okay, cool.
Hey, we'll take another question here. Go ahead.
Can you kind of review what happened to Apple after earnings versus Netflix after earnings?
Oh boy, I got an expert right there, Chris.
You want me to answer that?
I want you to answer that.
Well, the biggest issue with Apple is gross margins got crushed. They were about 44% down to 38.5%. That's basically because they went through a whole new cycle of products from MacBooks to iPods. And simply they just didn't have the earnings growth that the street expected and continued to go down. Netflix is a different story. For one, they have Carl Icahn buying up shares like crazy back when it was at 60. And that was when everyone thought the company had a chance of going under. They had a lot of debt. They were buying a lot of media. The biggest reason it popped is they started to show signs of growth, not just in the U.S., but international, and that's where they've been expanding. And the market really expected them to have a loss, a slight gain. Took it up, and that's one of those 120-plus multiples. Hopefully that answers it.
He's our internal Apple guy, so, which we've had a lot of discussions around. So, Okay, let's do our drawing and then I'll hang around for questions. I'll go hang around. Okay, first one is the books. Jeez. Bill Rupert. There you go, right in the middle.
All right.
Okay, another set of books. Frank Sozda. Did I get that right? How do you pronounce that? Sazda. Okay. Walter Piotrowski. Is that close? Piotrowski? Okay, way down there. We having fun yet? Is this fun? Spending my money? Is that good?
Everybody is waiting for the
That's
silver.
3. Is that 4? Yeah, I think that'll be 4. Okay, one more? One more. 1, 2, I only got 3 up here. Right down this edge. Okay, Brad Meddert. Is that right? Right down there. Is that 5 books? That's only 4 sheets.
I've got one other set.
Oh, one more? Okay. Paul Kramer. Kramer. Paul? Anybody named Paul?
Yeah.
Got to be here to win. Was that him? Yes. Okay. Okay, that was the boring stuff. Here's the exciting stuff. Okay. Silver Eagle. Mark McGovern. Mark? McGovern? There you go.
Yeah.
By the way, for tax purposes, everybody who wins has to come up here and have a picture with me at the end. So, I'm serious. We're gonna. Okay. Timothy Brickner and Deb Graves. How you're going to split that is beyond me. That right here in the middle? Right there. Tim Brickner. Okay, next. Dennis DePennant. DePennant? Right here on the edge. Was that worth an hour and a half of your time, was it? There you go. Hey, I think our first female, isn't it? Out of all the prizes. Jean Sparks. Jean Sparks, way back in the back. Okay, one more? Do we have one more, Doug?
Yeah, one more.
Okay. One more. Frank Pokornik. Pokornik, right here? Is that how you pronounce that? You're not making any friends up here, I noticed that. Very good. Congratulate right here in the second row. Blue shirt there.
Okay, there you go, great.
Okay. Thank you all for coming. And I'll hang around, Doug will hang around a little bit up here.